What's up, everybody? Welcome back to the channel. My name is John and this is John Paul Investing. Now, I cannot tell you guys what to think, but I can tell you what to think about. This is a famous quote by Michael Saylor, the CEO of MicroStrategy. So today I wanted to talk to you guys about how I think this is going to turn out over the next year, possibly 2 years and beyond. I can't predict the future, of course, no one really can, but we can kind of put things together, put the puzzle pieces together and figure out what we think the market is going to do and how it's going to affect our values in our assets and investments. And just to conclude, before I even get to the end of the video, my scope on investing right now is you should not have much in savings. You should have, just enough to cover maybe your 6 months of expenses. Maybe you have like $5,000 or $10,000 aside for like deductibles. But besides that, you should not be holding on to too much cash because the money printing over the last year and interest rates has caused everything to soar in price. Not necessarily value, but everything has soared in price. And if you want income producing assets, it is going to cost you a lot more now than it did pre-pandemic last year. But before I got into that, guys, make sure you hit that like and subscribe button. This way you get notified when I make videos just like this one, and it's a way for you to show your support for the channel. And don't forget your 2 free stocks using the WeBull link in the description. All you have to do is deposit $100 and you will get 2 free stocks, which you can then sell and do whatever you want with that money. It literally is risk-free money, guys, so I highly recommend you guys check out that link. And it's also another way for you to support the channel. And one thing I left out in the beginning of the video is to kind of look at yourself like a publicly traded company or even a private company. And what I mean by that is the same way that you look at other businesses and evaluate them is the same way that you should analyze your own financial position in things. So just like all business, for the most part, you will have financial statements, right? So you've got to look at your own income statement. You've got to look at your own balance sheet. And of course, you will have to look at your own cash flows. Am I making enough money to cover my expenses? Are my expenses too high? Do I need to downgrade? Do I need to make more income if I want to keep all my expenses? On the balance sheet, where do you keep your money? What investments do you have? So as far as cash flows, you have to think about, where are you putting this money? Are you spending it on investments? Are you buying luxury and leisure items? Anything that would affect where the money goes would be on the cash flows. So the best way to set yourself up is to adjust everything across all 3 of your own personal financial statements to position yourself to be in a great spot to be able to invest your money and really grow yourself as your own personal business or bank, however you want to look at yourself. We are all getting older and time is not going backwards, so it's important that we figure these things out now and position ourselves to become financially independent in the future at some point, whether it's 20, 30, 40 years down the road. Of course, depending on who's watching. So 10-year treasuries have been on the decline since the 1980s. Bond prices should continue to fall right now as the bond yield is climbing, and vice versa. When the bond prices start to inflate, then yields will continue to drop. So I wanted to talk to you guys about the US 10-year treasury yield. This is the guaranteed sovereign debt, where when you buy bonds, they are promising you this return. And right now, the current promised return is 1.67% over a 10-year period. So pre-CV19, we did see it was like a modest 2.25%. I think at some point like 3%. And, CV19 happened. They dropped interest rates to, start circulating more money. That way it can, keep the economy's heartbeat going. And essentially, this is what incentivized them to keep rates low. But as things start to, pick back up and the economy starts to open, we are seeing the yields kind of, rise up again. And I think this is going to be short-lived, and I'll tell you why. So using all the data that they have here on CNBC, we can see that the treasury yields have been in a decline over the past 30 years now. It has been a steady decline as well. We have seen some troughs, we have seen some peaks. And something I noticed is that every single peak that has been made over the years, major peak, has pretty much failed to be broken. And this has been continuing ever since the 80s. So literally since the 80s, we have not been able to surpass any yield highs. For example, around 15%, we had 14%, and then we had around 10%. We had 8%, and you get the drift. Right now we are approaching back up to around 2%, but I think what's going to end up happening is we're going to get pretty close or not even touch this at all. I think what's going to end up happening is we're going to see interest rates start to pick back up probably over the next month or two. And then once it starts to get to the 3% yield, I'm not sure exactly where bond prices will be at. At some point, we will see some resistance in the treasury yield. And I think, of course, this is my personal opinion, guys, that this will not recover beyond 3% at any point in the future. It's not going to happen. We're not going to see 3% ever again. Now, I will add that I'm not like a macroeconomic expert per se, but the thing is that whenever they raise the interest rates, it's going to make borrowing very expensive, which would then, not incentivize people to go out and borrow money and start to create things on debt. They'll be incentivized to save their money if interest is high, and not much spending is going to happen. And we already know, based recently on some news that we got from the Biden administration, not to talk about politics or anything, but they want to roll out a new infrastructure bill that is going to cost, between $3 and $4 trillion. Jerome Powell also came out and said that they are going to continue purchasing bonds, which releases more money into the economy as well. And he also said that the economy is not quite where he wants it to be, which means that they are going to continue printing money, possibly more stimulus that we're going to get, aside from the money that's going to be necessary to, promote this new infrastructure bill that the Biden administration has been in the talks of rolling out over the past few days. So this is just something to think about, guys. The more they start to print money, the more assets are going to inflate in price, not necessarily value, but price. Everything is going to get more expensive if there's more money circulating because you will then essentially have to share all the money printed with everybody else. So if all of us have $1,000 in the bank and they print $1,000 more for each of us, we did not make $1,000. We still have the same amount of money, respectively, with each other. The ratio is the exact same. It's just everything looks more expensive. Now, another thing I wanted to bring up real quick, if you guys don't already know, I'm sure some of you do, the M2 money supply tracker was discontinued. The question is why get rid of the tracker when the amount of new money entering the economy is pretty much at, astronomical rates that we have never seen. So as soon as the chart starts to go parabolic, they get rid of it. They really didn't want to give us a visual representation of, what the economy is doing. Essentially, they're, just getting rid of the easily accessible visual representation of the money supply, which I'll show you right now. So looking back, early 80s, there was probably around $1.7 trillion in circulation, and it started to go up pretty steadily. We actually did see kind of a slope increase, passing the 2008 era of the real estate financial crisis that happened then. But once we approached, CV19 era back in March last year, we will see that the money printing has been exuberantly high. We went from around 15 trillion in money supply to beyond 20 trillion in just last month in March, including the most recent stimulus of 1.9 trillion. And we are expecting more trillions, going into the end of the year. It is likely to happen. I can't guarantee it, but it is likely we're going to get a lot more stimulus before the end of this year, possibly even before the end of this first half of this year. So now I want to get into the takeaway from all of this. What is the takeaway? Why is this stuff important? So what does this mean for our portfolios? Do our assets follow suit with the amount of money that is entering the economy? Does the price associated with the, increase in money supply actually mean real value? A lot of the gains that we experienced last year were artificial. None of it was, really real because, for one, the economy was shut down. Everyone was at home for the most part. So explain to me why everything essentially shot up like 10x, especially among the tech stocks. Fundamentally, they were, getting more business online, but it's not really justified for, 10, 20x in some of these stocks that we saw. This money had to come from somewhere, and I think that a lot of this had to do with the initial stimulus that we got earlier last year. And what I think is happening right now is that, if they continue to print cash, they're essentially debasing the cash that was originally in circulation, meaning they're pretty much diluting you out of the value of your dollar. So if you had money sitting under the mattress before CV19, let's say you had $10,000 at that specific time, it's very likely that that $10,000 in purchasing power might only get you around $6,000 worth of the same stuff at the same value pre-CV19. And the way this works is that you're not just gonna, end up missing $4,000 under your mattress or anything. What's going to end up happening is you're going to have to pay, maybe $4,000 more for the same thing that you could have bought for just $10,000. Nothing really changed, right? But you're having to compete with more people that have more dollars for the same thing that was already there. So essentially what this means is that things are inflating in price, not necessarily value, but price. So any downward trends that we start to see right now, especially in great investments and, safe haven assets, even though these things are dropping, we will see these things recover at some point. So eventually the competition raises bids, kind of like an auction. Bids will start to go up and things will start to increase in price because there's simply not enough things to invest in and basically too much money to be sitting on and constantly losing purchasing power by holding onto that cash. And that is a big reason why MicroStrategy and Tesla moved a lot of money into Bitcoin. Now, what is the history of the strongest, most successful fiat currency right now in existence? As of today, the British pound is the longest running fiat currency since the late 1600s. And a question is, why is it so strong? Why has it been around so long? And the main reason is because they did not make that many British pounds, and their economy, their GDP, has been on the rise steadily. So essentially, their currency is deflating against all of the assets that the country has as a whole. So I wanted to bring up this interesting data that I found on Investopedia. It is kind of old from, the middle of last year, but it is still relevant today. And you could still apply it, you just have to change the numbers a little bit. As of July 2020, nearly 1.93 trillion US dollars were in circulation. By contrast, the total pounds in circulation came to a mere 70.16 billion. So there is essentially almost 30 times more dollars for every British pound there is in circulation. A good analogy is comparing Berkshire Hathaway to Microsoft. Berkshire Hathaway has a much smaller market cap than Microsoft, but trades at almost 1,000 times the stock price. Why is that? Well, that's because there is simply a lot more shares of Microsoft than there are of Class A Berkshire Hathaway shares. Berkshire Hathaway, as of this recording, was trading around $326,000 per Class A share, compared to Microsoft trading at around $236 per share. Now, a way to look at this on a macroeconomic scale is to imagine the market cap of the US economy going up simply by stimulus. So they create more shares, more dollars. So essentially, they're creating more shares for the economy and distributing it without basis, really. No one's really creating anything. They're just trying to, help us. They're essentially increasing the supply of dollars. One thing I also wanted to mention is that the European Central Bank, or the ECB, mentioned continuing their bond purchasing well through the end of March 2022 at the very earliest, spending around 190 billion euros per month purchasing bonds. So a lot more money is not just entering the market in the US only, it is happening on the other side of the globe as well. I'm speaking from reference in the US because I live in the US. I know a lot of you guys are in Europe too, but that's just the perspective I'm giving it here. Powell did say that he would love to see the Europe market growing faster, but are they actually growing? This is what you guys should think about. Are we actually growing, or is it artificial growth? So one thing I wanted to point out as well about Bitcoin is that in 2017, when we experienced that crash, the only way to, secure any cash back on your Bitcoin was to sell your Bitcoin. This was a taxable event. It was really the only way to cash out of your Bitcoin or get liquidity out of your asset, your Bitcoin. And because it was, predominantly ran by retail investing, it was very short-term in nature. But now we started to see new lending products come out with Bitcoin that I think you guys should really start to consider and learn about. Right now, it's still not very mature. There's still a lot of inherent risks with the products available right now. One of the main ones to me being you have to give up your Bitcoin in order to receive the collateral. I want to see a loan process where you simply have to prove ownership of a wallet that you keep custody, and then they give you cash on it. That would be the best way because, Bitcoin's built around trust, and they could potentially blacklist anyone who doesn't repay a loan. So that could be, a potential solution to the Bitcoin lending problem in the future. But, the main point I wanted to bring up is the fact that there's now institutional inflows into Bitcoin, and there are now new financial instruments that are allowing investors to take loans against their holdings in Bitcoin. This is very similar to what investors do with real estate. What they will do is they will pull equity out of their real estate. It is cash flowing. They don't want to sell it, but they still want to pull some money out because they want to be able to leverage up that property into new property or other investments that they, choose. This is a much different environment in 2020 than 2017. Again, this is my personal opinion. I think this is a totally different, ball game in Bitcoin, especially if they start to come up with new products that basically make no reason to sell your Bitcoin, but to just take loans against it. This means that there's going to be a lot less Bitcoin out there in circulation. But the point is that there is new infrastructure, being built around Bitcoin that is going to enable it to really replace a lot of safe haven assets that we're used to, like gold, like bonds, and things of that nature. You guys can say something about that in the comments. I would love to see a discussion about this, but this is just how I see things, and it is something that, again, you guys should think about. So again, while I cannot tell you guys what to think, I can tell you what to think about, and I think that's a really important lesson to learn because It's not always how you see it. It is how things really are that you have to try and grasp and understand, and try to put the puzzle pieces together as best as you can, so that way you can really ignore any of the short-term FUD, which is fear, uncertainty, and doubt, any of the the noise that we see in the news, in the markets every single day. You become a lot better at filtering out the crap and focusing more on yourself and what you know is important. Like I said earlier in the video, guys, one thing that I think is going to be really important is that you really control your financials, kind of like a business, really a lot like a business. Make sure your income statement's good. Make sure your balance sheet's good. Make sure your cash flows are good. It is a long-term game. It is slow. It is boring. But if you focus on the fundamentals of things, you'll come out on the other side with a lot more value than you probably think you would have had. But anyways, guys, that is it for this video. Thank you guys for making it to this point. I really appreciate everyone who has, stuck around, especially in the Patreon group, because I have been gone. I have been working on a side project, my own personal wholesale real estate business here in Houston, Texas. I also have been trying to figure out ways that I can, pull money together, not just for Bitcoin or Nano Dimension or Sensonics. I'm trying to pull money together also for my first investment property. I just linked up with a private money lender who I think is going to be able to work with me. I just need to save up a little bit more money before I can get my feet wet and get in the first deal. But this is going to be something that I will possibly share on another YouTube channel. If you guys think I should make another YouTube channel for the real estate once I do get my hands on my first deal, let me know in the comments. I would really like to create a YouTube channel on it, but if it's not really something of interest, then I won't do it. But that's just something that I'm very excited about, so just wanted to share that with you guys too. I had to take a little break. I was making videos for like 4 months straight. I'm sorry if it felt like I was neglecting some of you guys, but at the end of the day, I love you guys. You guys have been with me since the beginning, and I just needed a break away from YouTube because staring at your computer screen for like 4 months straight is very taxing on your eyeballs and your brain. If you liked what you were watching, please go ahead and hit that like button. And while you're down there, go ahead and hit that big red subscribe button. And don't forget to hit the bell notification to get notified when I make videos just like this one. I hope you guys learned a valuable lesson from this, and I will see you in the next video.